And joining me now to provide insight on the day's market performance is Andrew Padoa from Sasfin Wealth. Andrew, thanks so much for your time this afternoon. So,
thank you.
That trade truce between China and the U.S. seems to be off the table. There are reports saying that China has said that the U.S. has violated the truce. We're also seeing, that announcement from Trump where he's doubled tariffs in the steel industry. That not really boding well for equities at the beginning of the month, right?
No. Yeah, no, you're spot on, Tarling. I think, look, this tariff stuff is going to be around for some time. We did have the good news last week about the courts with Trump and all that, but now it's back to US versus China, and geopolitics are playing into it as well. My kind of approach to investors is to phase in money into equities. I think we've had a fantastic rally the last couple of weeks, and markets. I think for the risks that are out there, I think markets are a little bit stretched at the moment. So I think phasing in funds into equity market is a prudent approach.
Let's take a look at some company news now, Andrew. In the mining sector, Valterra Platinum, previously known as Amplats, has completed its demerger from Anglo American. Also now trading as Valterra on both the LSE and the JSE. What's your sentiment around, the PGM space in particular? We've seen some of those counters run over the past month on the back of higher prices. Is there value there? Are you seeing value there?
I am not. I think the only place that's really got me excited in commodities is that gold space. That's been really flying, and I think even today it's the gold stocks that are up again. When it comes to the mining space, I think gold has a role. Billiton, as the diverse low-cost producer in that mining space, has also got my attention, but I'd still keep weightings low in commodities. I think there's still issues in China. We really need some strong economic growth in China to see a catalyst for the commodity stocks.
And in earnings news, Raubeck's out with numbers delivering double-digit growth in both its top line and its bottom line. The results also come after it completed a probe and said there were no incriminating findings. Markets seem to love the numbers. I saw that the share price was up over 8%. What do you make of those numbers?
Yeah. Well, fantastic set of results. I also think that probe is kind of out the way. I think that also gives a bit of sigh of relief to investors. But, revenue up over 20%, earnings up over 25%. And it wasn't just a one-hit wonder. That order book is expanded over 10%. So it's difficult to really fault. And the shares, they were on a spot PE of 7 before these results. So no wonder the shares are up 8% today.
And then moving over to Sirius, also out with positive numbers being boosted by both organic growth and acquisitions during the period. Funds from operations up close to 12%. What did you make of those numbers, Andrew?
I think they were also strong. Like-for-like rent roll of 6.3% in Germany and UK. The group's declared its 12th consecutive annual dividend increase. We've been long-term shareholders in Sirius, and we've had fantastic capital growth as well as that growing dividend year after year. What really got my attention though in those results is Andrew Coombs' comments regarding defence. Management believe that the increased defence spending in the UK and Germany could become a major demand driver for warehouses and manufacturing space, and they're actively positioning the portfolio to benefit from this emerging opportunity. So we like Sirius very much.
And you said you hold Sirius. Just a quick one then, Andrew. Are there no concerns around the current macro conditions, both in the UK and Germany? We've seen some political uncertainty in Germany, growth in both countries quite tepid as well.
Yeah, I think Sirius did have an element of the German issues priced in a good couple of months ago. They got down to probably 18 Rand a share, and they've had a pretty good rally since then, and we're now kind of 22-ish Rand a share. So I think, yes, politics is an issue. I think interest rates and where we are in the cycle is also something that I'm sure Andrew Coombs keeps him awake at night, but they're managing that proactively.
All right, let's look at Telkom out with a trading update. They expect earnings to almost double. A windfall from the Swiftnet sale likely to boost the balance sheet. And the share price was also up over 5% this morning. Just your thoughts on that update?
Yeah, so a 95% rise in earnings is a hell of a move. We'll have to wait for the 10th of June to get more information. Like you said, they're disposing of SwiftNet. There's also changes to their retirement funds. So I'm not sure how much of this earnings increase is due to those factors versus actual operational performance. So we'll have to wait until 10th of June to dig under the hood and see all the numbers.
All right, before we move on to the stock picks clips, let's look at momentum for a minute. They described their 9-month period as solid. The group also mentioned that it got the nod from the Prudential Authority to go ahead with that share buyback with R1 billion. Your analysis on those numbers?
Yeah, so new business sales declined 4% year on year. So the results were okay. It didn't shoot the lights out, not a disaster. They did improve in key segments due to a shift towards more profitable lines. We did see expenses rise modestly above inflation, largely due to incentive costs for management and then regulatory-driven IT spend with the two-pot system. They obviously had to spend quite a bit of money on systems, etc. They've got their capital day tomorrow, so I think investors will have a better idea of what the big picture strategy is when they have those announcements tomorrow.
All right, let's hit pause on the conversation and take a moment to touch on some picks that have caught your peers' attention.
So I'm going with an unusual name. It's called InPost, and it's a Polish company that does, e-commerce fulfillment. They run these automated parcel lockers. So instead of the companies delivering to your door, that last mile delivery costs these logistics companies a huge amount in terms of margin and expense. So rather what these guys have done is they've built these lockers. It's obviously fully encoded and automated. People can order, whether it's from whatever online shop they're at. They go and collect their stuff in their locker at their own convenience at a nearby location. It's built in Poland. They've got a massive market share, and they're expanding into the UK and France. And I think this is where a lot of e-commerce is migrating, because it's far more cost effective, and it's also convenient for the consumer who doesn't have to make sure someone's at home to collect the delivery, etc., etc. So I think this is a growth area. I think it's a good management team. I think there's a long runway for growth, and I think it's a good entry point as well. So that's my pick of the day. It's InPost.
My pick is Reinet, another company that came with results this week. Because of the exit out of British American Tobacco, which I thought was quite monumental at the time, we have sort of weaker optics on what the underlying discount is doing. And given that all of the assets are unlisted now, we have to wait for these quarterly updates. At least it is listed in Luxembourg, so we get quarterly results, which is nice. But we got the full year results to the 31st of March. And now we know what the discount is. This discount, in terms of our modeling at the moment, is around 38%. Updated since that 31 March print, which is quite deep for the structure. And we like in the first place the cheapness of that implicitly, and we like the underlying assets. We like the execution inside of Pens Corp in particular. That business still has significant momentum. It's executed very, very well, and we're seeing significant growth in that.
Kwaba's going with an oldie but a goodie, Reinet, and Grant picking InPost. Just your analysis on those counters.
Sure. So InPost, I'd actually, to be honest, had never heard of that business prior to today, but it seems like a really interesting business and a very clever business model. I had a quick glance just to look at their valuations, and their valuations look far from excessive. So that's definitely one for investors to kind of have a second look at. If we move on to Reinet, I think Reinet is a good choice for the conservative, long-term South African investor. It's kind of the closest thing to Berkshire we can get on the JSE, not because of their underlying investments, but more from that focus on capital protection and their long-term thinking. And obviously they've got the big discounts at the moment. So if you're an investor on the JSE with a 20-stock portfolio, I think Reinet should, be on the radar.
All right. And then where are you seeing opportunity? What are you hanging your hat on this morning?
Sure. So I'm going with S&P Global. In investing, barriers to entry matter because competition is the enemy of returns. So long-term investors must truly understand a company's competitive advantage or their moat. And I think S&P Global has one of the widest moats you can find. If a company or government wants to raise debts, they have to get a credit rating, and only 3 firms dominate this space: S&P Global, Moody's, and Fitch. And these companies have all been around for over a century, and together they control 95% of global credit ratings.
All right, Andrew, thanks so much for your time and sharing analysis of markets at midday. That was Andrew Padoa from Sasfin Wealth.